Shares of Zion's Bancorp and Western Alliance both lower here in overtime after reporting quarterly results. The regionals ETF KRE is down 16% so far this year, but is coming off a strong week of gains. It's best since January. Joining us now is Baird Senior Research Analyst David George. David, it's great to have you on. I'm actually going to start with some of these results and how it fits into what we're hearing in general this earnings season, specifically from Zion's, where it seems like they reiterated their credit quality and excuse me, where they reiterated their credit quality and basically said they're in very good shape and did reference the uncertainty of tariffs.
They did. Good afternoon. And Zion's is kind of bringing up the rear for bank earnings season for us. We're finishing earnings season over the next couple of days. I think Capital One is tomorrow after the bell. But Zion's, from our perspective, Morgan had a relatively good quarter. They met our expectations as well as the streets for what we call pre-provision net revenues, or PPNR, and they were in line with our number as well as the consensus. The outlook was maybe a little lighter, and that's a function of just maybe a little more subdued expectations, Morgan, around loan growth, as well as a little lighter outlook as it relates to fees. But as you mentioned, credit quality was good. Expectations, we think, were relatively low with the stock at just over book value. And I think the 6% down reaction probably lessens quite a bit by the time we open tomorrow morning.
David, are we yet seeing a clear impact or expected impact of the macro situation on the regionals?
We're certainly seeing in the stocks, and the first quarter numbers, John, have been good. Loan growth has picked up, and interest margins have shown improvement. Capital is good. But as you said, those numbers, while very good on an absolute basis, they're really old news. And now everyone's focused, market participants are focused solely on the tariffs and the implications of those tariffs on credit quality as we go through the balance of the year. We've obviously seen some gyrations, John, as well, in the bond market, and there's some implications around that. So clearly, the future is uncertain at the moment. The stocks, fortunately, are trading, we think, at relatively discounted multiples, and the risk-reward trade-off today looks much better, actually, than it did after President Trump was voted in office, given that move in the stocks downward.
With a green light happening, at least from a key regulator here in the U.S. for this Discover Capital One deal to move forward, do you expect we could see more M&A among the regional banks here, especially if we get more deregulation?
Yeah, I think the hopes, Morgan, is that we do get more bank M&A. I think that the move down in the stocks, I think, potentially may curb that activity or curb the enthusiasm around bank M&A in the near term. And that's just a function of the fact that a lot of these management teams would be unwilling or less likely, I should say, to be willing to sell at these prices. But the arguments for bank M&A are clearly there. There is a need for scale. And the big banks have gotten much better on the street from a day-to-day competitive and blocking and tackling perspective. So from our standpoint, there is a very compelling argument for bank M&A. We're hopeful that we get some clarity around tariffs, a little more clarity around deregulation, and the stage is set, we think, for more bank M&A activity going forward.